All right, so lots of anxiety out there about this bull market, folks. People are so anxious. By the way, we entered today, it was day 1,203. Now, the average bull market lasts about 1,011 days, so we're a little bit ahead of that. But remember, the longest was 4,494 days long. And by the way, we're still below the average gain of 114,000. Of course, it's not just the length of the rally that has folks on edge right now. I want to bring in Piper Sandler, the chief investment strategist, Michael Kantrowitz. And, you know, we knew it had to happen. We knew it would happen. And yet the reaction to tech, struggling, the rotation, software getting hit, it's you don't necessarily see it in the market, but you feel it, right? It's palpable. There's a lot of anxiety about it. What are you telling investors?
Yeah, we've been recommending since the fourth quarter of last year to start rotating into areas that are value, cyclicals, that are going to benefit from better manufacturing data, a little bit of healing in the housing market as well. And looking to rotate into the market led by areas that haven't been leading the market since 2021.
I guess the question has been, because people just look at the overall market, say, okay, the S&P is up or down, equal weight's done well, small caps are doing well, value's leading the way. Can they do the heavy lifting though? Can we have an up year with the growth names sort of struggling?
Yeah, we can, because the Mag 7, the top 10 stocks are about 40%. So you need a 2-to-1 ratio for everything else if the market goes down a bit. But yeah, I think we're going to see a lot of what we're seeing this year. This is not the year to own the S&P index. This is the year to own the equal weight, the mid cap, the small cap, the value index, and abroad, international. Right. Look for cyclicality in areas that are improving for the first time in 4 years.
So the old economy is coming on. We're starting to see signs of that. The old economy boom, which, by the way, people voted for and hoped for.
Yeah.
And I guess the question is it a flash in the pan? Because we've seen hints in the past. Yep. What makes you so much more convinced that this time it's got traction, the potential for traction?
Sure. Well, I would say, the last 2 years we've seen lower interest rates, rising money growth, lower oil prices. We've seen better housing data starting last year with the purchase index up about 20% over the last year. So these are all things that lead to a broader economy, and we're seeing that now show up in manufacturing data. This month, in January, last month,
that was huge.
We hit 70% of U.S. regional and national services and manufacturing PMIs. 70% of them are now in expansion. That's the highest in 4 years. Right. That is what begets broader earnings growth, which is what we're seeing, and it gets a rotation in the market that we're also seeing.
So the two wild cards a lot of folks are bringing up, we've got a new Fed chair, and everyone's got an opinion on Warsh, right? Yeah. And it's almost, you can tell me what side of the political aisle they're on, and I'll tell you what their opinion of him is, right? Yeah. But they're all valid in the sense he's got a long track record, because you can cherry pick. Well, he was this way at one point, he was this way at another point. Unknown. And then the midterm elections, which usually can create some havoc. What are you telling investors with respect to those two potential market-moving events?
Sure. Well, I'll start with the midterms. I actually think it's bullish that we have midterms this year. Technicians will typically tell you that years where you have a midterm, the market does poorly the first 9-10 months of the year, then does great in the fourth quarter. I think we're going to see somewhat the opposite, again, at least more in the cyclical value space of the market, because I think President Trump has been very vocal and announcing a lot of programs and policies to help the lower part of the K, the weaker consumer, smaller businesses, housing sector, healthcare. And so I think we're going to continue to hear that at least until the midterms. So I think it's a unique year in that sense. And then, sorry, what was your first question?
Warsh, new Fed chair.
Yeah, I think we're going to have to hear what Warsh's reaction function. When we had the inflation shock, we all kind of got a feel for how Powell was going to react to data. I think we're going to have to kind of go through that again with Warsh. So at the end of the day, is he going to affect earnings, and is he going to stop this cyclical upturn that's taking place? I don't think so.
Well, on one hand, we know he doesn't like QT, but on the other hand, he's been very vocal about lowering rates. Yeah. But, so that'd be okay for Wall Street, I think.
Sure, and only if we get really bad jobs data.
Right.
If we get better inflation data and lowers rate, that's the best case scenario for equities and risky assets.
Right.
But I don't think we need interest rate cuts as much as we did a year or 2 years ago before the Fed started cutting rates.
I agree with you 1,000%. Work is fantastic. I'm glad you came down here. Pick up a couple Bitcoins on the way out.
I will.